Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we are focusing all our attention on UiPath, ticker symbol PATH. We're using fresh data captured this morning, October 9th, 2025, and we're doing a critical deep dive into this enterprise automation leader, really trying to answer one key question. Is the recent surge pure strategic automation, or is it maybe just pure irrational exuberance?
Yeah, and that question is especially relevant today because the macro environment is, well, it's throwing some mixed signals when you say pre-market futures are a bit flat, maybe NASDAQ lagging slightly. But the big story, the headline story, is still this persistent drumbeat of recession warnings. You got JP Morgan, Oxford Economics, all flagging caution. And that means high-growth tech stocks, like PATH, they're trading in a pretty skeptical, headline-driven kind of environment.
Okay, so given that backdrop, that drumbeat of recession warnings you mentioned, how is UiPath trying to buck that trend? They seem to have this incredible AI narrative going on. I mean, they've locked in these major collaborations with AI titans, NVIDIA, OpenAI, Google, Microsoft. That theoretically positions them perfectly for the future of automation, right? It fuels this compelling investment thesis that the market seems to be, well, really buying into.
It is compelling, definitely. But our research reveals some major internal conflict here, some conflicting signals. Just as the market is celebrating this big AI move, we found what looks like a giant warning sign. The CEO, Daniel Dines, he sold over $1.6 million worth of stock.
Wow.
Now, yeah, it was reported as pre-planned, okay. But the optics of that timing, it's certainly, let's say, interesting. And add to that, Wall Street analysts, they're clearly not believers yet. 15 out of 19 rate the stock as simple hold. Just neutral.
15 out of 19. But if the market's ignoring those recession warnings because the AI story is just so powerful, maybe focusing purely on traditional fundamentals is, I don't know, a distraction. Our own free cash flow analysis pegs the fair value for PATH at only $11.97. Why should investors care that this is so far below the current price? It's sitting well above $15.50 right now.
Well, you should care because FCF, free cash flow, gives us that objective measure. It's the company's actual financial health, kind of regardless of the market sentiment or the narrative. That gap, nearly $4, signals a significant potential overvaluation based purely on the real cash the company is generating, or isn't generating, perhaps. It tells you the stock is currently priced much more on future potential, on hope, not necessarily on current performance.
Okay, that valuation disconnect makes sense. And it really leads to this truly polarized sentiment we're seeing. It's like a massive tug of war. If you look at the options market, for instance, it's definitely a bull party going on there. The put-to-call ratio is astonishingly low, 0.07. That means, what, roughly 14 bullish bets for every single bearish one?
Exactly. Huge bullish skew in options. Yet, the short sellers, they are absolutely standing their ground. A hefty 14.53% of the available stock is sold short. That's not insignificant. And it requires over 4 days just to cover those positions if they needed to buy back. That creates an extremely, well, combustible technical setup.
So what are the charts telling us? How is this fight actually playing out visually?
Yeah, the charts really show this dramatic clash. You've got this decisive short-term power surge, right? A clear breakout on the chart. But this clashes directly with the long-term structure. The 50-day moving average versus the 200-day, that trend remains firmly bearish. So short-term strength, long-term weakness.
A real conflict there.
And this raises a critical question. Is the money actually supporting this surge? Is there real buying pressure behind the price move? Momentum is undeniably strong, almost off the charts. It's pushed the stock deep into what we'd call textbook overbought territory. RSI, stochastics, they're very high.
Okay, overbought, but what about the money flow itself?
Right, that's the crucial part. We see high expanding volatility. The price swings are getting wider, but alongside that, there's a major warning from the Chaikin money flow indicator. It's flashing bright red. That suggests quiet distribution might be taking place.
Distribution. So like sophisticated sellers are maybe offloading shares quietly.
Potentially, yes. They could be selling into the strength, using the excitement around the AI story as cover while the price is still high. It's a concerning sign.
Okay, so connecting all these complex threads, the AI hype, the CEO sale, the valuation gap, the options versus shorts, the technical picture. What does this all mean for you, the listener? After weighing the risks and acknowledging that powerful momentum, the final verdict from our research comes out as cautiously bullish.
Cautiously bullish, exactly. The risks, let's be clear, the CEO sale, the potential overvaluation, the heavy short interest, those overbought indicators, they are massive risks, huge. But right now, that short-term AI narrative combined with the technical breakout means momentum is king. The stock is currently priced largely on speculation, and momentum keeps that speculation alive, for now.
So the battleground seems pretty clearly defined then. What are the key levels people should watch?
For the bulls, they absolutely must conquer that pre-market high we saw, around $17. Getting decisively above that level could be the trigger for a significant short squeeze, forcing shorts to cover.
And the downside, where does the bullish idea break?
The critical line in the sand, the invalidation level for this whole bullish momentum thesis, is it closed below $15. If it closes below 15, that's a strong signal the bears have successfully wrestled back control.
Okay, $17 on the upside, $15 on the downside, key levels to watch. So whether UiPath is ultimately being driven by intelligent automation strategy or just pure speculative euphoria, well, watch those key levels very closely. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.